what about the custody layer? Because that was one of the things that really spooked me back in 2012 when Europe almost went under. I realized how fragile that whole custody layer was, and that at DTCC level and Euroclear level, there was no segregation of assets. It's a big swamp, and if a sovereign ever defaulted, I mean, the whole thing is gone. What about the custody layer? How do you see that working out with blockchain? Because it clearly has to move there.
Well, I think two parallel systems, right? We've got the crypto custody that's happening, that's built for how custody should be. And then we've got the old traditional system that is not built for how custody should be. Most people think that when they buy shares, that they own the shares. And you and I both know that's not the case. What we own is an IOU from our broker-dealer, who owns an IOU from their custodian, who owns an IOU from the centralized authority, whether it's in the securities markets, the DTC in the US, Euroclear or Clearstream in Europe, or even that's the way money works too. You all ultimately, all the banks own IOUs coming from the Fed. So you've got, again, this layered system where at the top, you've got the centralized authority that's the real issuer. That's where the property right is. That's where the legal title to the asset is. And then everything that they issue down in these subsequent layers is just an IOU hanging off that. And it took me a while to figure that out. I remember reading a bond prospectus and seeing that in the bond prospectus it was a Procter and Gamble bond, although they're all the same. There was an express disclaimer that the issuer of the bond does not owe any payments to the owner of the bond. And it's just the strangest thing when you read it. Wait a minute, what am I paying for if the issuer doesn't owe me any principal or interest payments? What on earth am I paying for? And the answer is the issuer owns the principal and interest payments to their depository, to the trustee, and the trustee in turn owes the interest and payments to the custodian, and the custodian in turn owes the interest and payments to the broker-dealer. So you, by the way, if you think about the legal structure of that, you have no what's called privity to the issuer. You can't sue the issuer. Your broker-dealer has to sue the issuer if something goes wrong. And you can't make your broker-dealer sue the issuer. So it's very screwed up. It's not the way custody should work. But yet, there's nothing nefarious, it is worth saying, about how this market structure evolved. And it's because of technology limitations that once existed. So this market structure was the best we were able to do back when securities were in paper form. And even when they first started going to more to what's called dematerialized form, the early versions of technology, it made sense because both processing power and storage in IT was very expensive. And so what you wanted to do was minimize the number of transactions that were processed every day. And that's why we have this delayed net settlement system with all these multiple layers of intermediaries. Everybody's netting. So when you go to Charles Schwab and you buy Apple shares, they're actually not giving you the Apple shares, the real thing. Now we know that. They're also netting up against somebody who's selling Apple shares within the Schwab system. And so every night what they do is settle. Now it happens more than once a day, but back then it was literally overnight. This is why it took, when I started in securities, it was 5 days to settle a stock trade. Then it was 3, now it's 2. Why isn't it real time? That's long ago not a technology limitation, but you can sort of start to see why, because all these, you have to net the buys and sells, and then the different broker dealers will net the buys and sells against each other, and then the custodians will net all their netted buys and sells with the DTC every night. And guess what? The systems never are in perfect sync with each other, because by definition, a delayed net settlement system will never have all the records match. And so what happens is you have these fault tolerances, shall we say, that are built into the system where everyone understands that you may have, on average, I would guess it's maybe 1% to 3% difference between the actual number of shares outstanding and those that are recorded on everyone's brokerage statements. And we had an extreme situation that illustrates the point. In 2017, a lawsuit in the Delaware Chancery Court, and all the owners of Dole Food had to turn in their brokerage statements to claim additional consideration in a merger. The facts on why they had to do that aren't important. What's important is that there were 1/3 more claims to the Dole Food shares filed with the Delaware Chancery Court, all of which were backed up by valid brokerage statements. 1/3 more claims than there were actual Dole Food shares. So let's stop and think about what that meant. That meant that Wall Street was satisfying real demand for the Dole Food shares with fake supply. And anytime you have fake supply of something come into the market, what is it going to do? It's going to suppress the price. It's simple supply-demand dynamics. And so this is not a zero-sum game. This is not let's go figure out who the real owners were, because the real owners had their pockets picked, because all this fake supply was coming onto the market that was satisfying real demand, and therefore the price was being suppressed. And so, that's the problem with all this. It's not necessarily nefarious. There were definitely nefarious people involved in the Dole situation. I think actually, because your listeners are sophisticated people, you will definitely understand this. I'll go into a little bit of what happened. And here's the challenge: companies cease to exist in a merger on the day of the merger closing. So let's call it June 30th. I think that's what it was in the Dole case. It was June 30th. The problem is, as we know back then, stock trades were settling 3 days after trade date. And so you actually had the stock trades for June 28th, 29th, and 30th settling on July 1st, 2nd, and 3rd, right? So literally the company ceased to exist on June 30th, but you had those final 3 days of trading that had to settle after the company ceased to exist. Well, the problem is that the depository trust company doesn't actually still own the securities. They had to turn over the global certificate for all the Dole Food shares to the acquirer in order for the merger to close. You actually have to transfer title at that point. But you have all these securities that are still trading in the final 3 days of trading. And that's where there was definitely fraud, because there were a lot of probably hedge funds, merger arb hedge funds, who knew that they had sold the shares in the final 3 trading days, and who knew that there would never be a truing up of the actual shareholder ledger of who really owned Dole Food shares. And so they attempted to double dip. What I don't understand is why the Justice Department has never gone after what was an obvious situation of fraud. Why? Why did the SEC and the Justice Department just let that slide? I don't understand that. But it's a fact. And what I came to learn is that those situations exist in every merger and in every situation where the securities have to be turned over to somebody at a particular date. I learned all that through my pension transactions, because we actually transfer billions of dollars of securities on a particular date. And lo and behold, in one of those instances, the pension fund had put all of the securities in a segregated non-lending account at one of the large custodians. It was supposed to be in the trust company, segregated non-lending, and guess what? The custodian called the day before the merger was supposed to close, and all those securities were supposed to be delivered, and said, we don't have them. They had lent them out without the authorization of the pension fund, without the ability of the pension fund's chief investment officer to even tell, because his brokerage statement, when he logged into his account, showed that all the securities were there. And now you see how that can happen. Of course, it's going to show all the securities were there. The custodian owed the securities, but those securities were not real. They were just IOUs. And in those cases of the missing securities, they were fake securities. They were fake IOUs. And they were real IOUs, but against the fake securities. And so we had no way until the day before of discovering that. And that's not how custody is supposed to work. Custody is literally supposed to be a money warehouse. If you go back to the old gold money warehouse days, it's warehouse receipts.
It only gets more complicated when you add the fact that when I was speaking to the New York Fed, when I was in the process of looking at this bank, the New York Fed said, oh, by the way, the average US Treasury is reused 32 times.
32. Wow.
I'm like, wow.
Yeah.
I said, and who tracks the ownership of that? Basically, nobody.
They don't
And
have a
then
way. Yeah.
we added the derivative layer on top of all of that.
Right.
So, there's over, I think there's 1.2 quadrillion of derivatives.
Yeah.
And it's a mess. I mean, there is, yes, some of it's now gone on exchange, but the whole thing is, in the end, when it comes down to why I think blockchain is so important in this, is nobody knows who the hell owns what. And as you said, in the current system, it's not provable. That was what Lehman Brothers was.
That's exactly right. And there's a lot of details behind the bankruptcy law as well. There's a terrific article, maybe we can put it in your show notes, about it, written post Lehman, so a couple of years post Lehman, that essentially says, if we have a bankruptcy of a custodian, it's going to be very, very difficult to figure out who really owned what. And the reason is there's a conflict between state law and FDIC receivership law. And this gets to, we've chosen in the US to have liquidity matter over clarity of property rights in the securities industry, right? That's why we have all these IOUs. We just want trading, and in general the system works. And in these situations like Dole Food, okay, it's a mess, but to your point, if we ever have a default of a sovereign, holy moly, that's going to be a bloody mess, because we don't have a way to figure it out. And that's exactly what this article was laying out. It's a law review article, but everybody who's a fiduciary who manages money should read that article, because it's going to have an impact on how you structure your custodial arrangements. And what we learned in that situation with that pension client and the custodian, this was back in 2014, what we learned is that paying up for a segregated account actually bought you almost no additional protection, almost zero. In a bankruptcy, all that segregation is probably going to get broken. And so I know you and I talked about rolling forward to what Avanti's setting up and the whole Wyoming digital asset custody regime. We are absolutely the best custody regime in the United States, hands down, period. And the reason is because we've got a legal structure that defends the property rights, the clear title of digital assets. You can't do that with securities, because securities are all issued in this global security structure where the DTC has the legal title to the securities. So that's why, again, the market structure is so different. You really can't implement blockchain in that market where the security is not itself the native instrument. Whereas in crypto, the security, the Bitcoin or the digital security issued on, as an ERC20 token, et cetera, they are actually bearer instruments. They are the native instrument. You have to have the actual native instrument in order for custody to work the way it should, which is that it's essentially the custodian is just a warehouse. They're literally keeping the assets safe. It's very analogous to a coat check or a valet parking arrangement. You are not giving legal title to the custodian. You're not turning over the deed to your car when you park it in a garage. And all that garage can do is safe keep your car. They can't turn it, take it for a joyride and earn Uber dollars, driving it. That is, by the way, exactly what's happening in the existing custody business, right? Your custodian, as I learned the hard way for that pension client, was out there lending that client's securities, making money, posing risk to that pension fund, and not paying and not disclosing to the pensioners. Again, they had their pockets picked because of the way the system worked. And it's not fair. It's not right. Let's go to an actual outright direct property rights ownership structure, very similar, and actually using the exact legal concept called a bailment, exact concept of valet parking or a coat check. You're just temporarily turning possession of your assets over to the custodian, and they have to give your assets back to you when you demand them. No ifs, ands, or buts. And that's the way custody should work. And there's one and only one place where custody works that way, and that is in the state of Wyoming, and only for digital assets. For everything else, it's the old system.